Hey guys, how's it going? It's Andy from Magoo Investing. Happy Tuesday. Last night on my Discord server, we were talking about various option strategy, and I had a lot of people that were asking my opinions on using the wheel strategy. This is a strategy that I've been using for like 6 or 7 months at this point, and it's probably my favorite way to bring in reliable income. So in today's video, I'm going to give my thoughts and kind of explain kind of the basics of using the wheel strategy, because for most people, this is more on the intermediate level of investing in the stock market. The easy stuff is just buying and holding. I would call this the intermediate. It's not super difficult. And the reason I really like it is it's kind of similar to ice fishing with a tip up. Once you get it set up, you don't really have to do anything. You just kind of wait for a while until you have to make your next move. So for people that are not as available to be doing all this research on the stock market or worrying about the day-to-day movement of a stock, I think this is a great option for them. And with all the craziness of the market starting to slow down a little bit, I think it's a good time to start talking about some reliable ways to try to increase your returns on a yearly basis. We have been seeing these stocks that are increasing 100% in a single day, and while that's great for right now, it's not super realistic. And I do want to reiterate that my plan and my goal for my investing portfolio is to return 20 to 25% a year, and using the wheel strategy is my favorite way to try to add on to some of the returns. So in today's video, we're going to be breaking it down to a couple parts. The first one is I'm going to be talking about the individual parts of using the wheel strategy. I'm going to be talking about cash secured puts, I'm going to be talking about covered calls, I'm going to be talking about the two Greeks that I think are really important to kind of understand what they mean. And then I'm going to be talking about one more number that I think is important to understand the value that you're getting from your positions. Then part two, I'm going to be talking about the basics of using it, how I determine which option I want to be selling, what each part of it means, and kind of go through the flow chart of using the wheel strategy. Because on paper, it seems pretty easy, but there are more decisions than just, oh, you want to sell this put, you want to sell this call. You have to determine your risk and reward ratios, and I think it's an important thing to discuss. And then part three, I'm going to talk about some important kind of concepts that I think are important to fully grasp before starting the wheel strategy, because the wheel strategy is not difficult on its own, but there are some things that I think are important to understand so that you don't open yourself up to too much risk and you fully understand how to utilize this strategy. So if you already know the basics of how cash secured puts and covered calls work, you can go to the timestamps in the description and move on to part two where I explain how I use the wheel strategy. But for people that don't know, the wheel strategy, it's also sometimes called the triple income strategy, depending on how you use it exactly. But it's a pretty simple strategy when you just look at the graphics of it. There's just a couple parts that you cycle through, and once you get all the way to the end of it, you just restart it. But there are some parts that you need to understand before opening this position. First, I want to start by talking about a cash secured put. And if you call this a cash covered put, some people will get mad at you on the internet. What this means, the cash secured part, means that you have enough cash in your account to fully be able to buy 100 shares at the strike price that you sold. If you don't have that, that will result in a margin call, which is probably the worst thing that you can have happen to you in your investment career. Not something that I would ever do, and the whole idea of having the cash behind it is that you don't open yourself to too much risk. So that's the idea of the cash secured part. And then so the put is a type of option. What the put means is that the owner of it has the right, but not the obligation, to sell the underlying stock at a specific price by a certain date. And so the specific price is called the strike price, and the specific date is the expiration date. And so every time you talk about an option, you have to talk about the stock, the strike price, the expiration, and the premium. So those are the things that you need to know about each individual option. In exchange for that right to sell to someone, the other person is bringing in premium, or they're bringing on the risk of maybe the stock crashes through that. And for someone that is buying the put, it means that they're trying to limit their downside potential. But for people like me who are trying to get involved with the wheel strategy, I'm taking on the additional risk of having the potential to buy a stock that is going down in price, but I'm pocketing the premium. And then on the other side of the strategy is the covered call, which is pretty much the opposite of the put. What it means, instead of having the cash secured, meaning you have enough money to afford 100 shares, the covered call means that you already own 100 shares that you could have the ability to sell to someone if the option gets taken from you. And so just overall, a call means that the buyer has the right, but not the obligation, to buy 100 shares of the stock at a certain price by a specific date. In exchange for that, we also take a premium. So that's kind of the idea of a cash secured put, where you're bringing in money for the potential of buying 100 shares of the stock. And then the covered call is that you own 100 shares. You are selling an option that gives the person the right, but not the obligation, to buy those 100 shares from you at a given price by a specific date. And before we start talking about how I use this to make reliable income, we need to talk about the other parts of the options, because there's more to it than just looking at the strike price. You have to determine which one is the best one to be selling at any given time, because for people that have been involved on Wall Street bets, the way that they make such high percentages is they buy these ridiculous out of the money calls or puts. And so this means that they're very cheap, but the likelihood of them actually being in the money are so low, but they're trying to speculate on a stock that's going to go up significantly and make ridiculous returns from it. So you need to kind of understand what these Greeks and these numbers mean, because when you first open the options chain, it's a little intimidating. So the first one I want to talk about is Theta, which is the referenced Theta and Theta gang. And this is the way that people like myself make money from selling options. And so Theta, the idea of it is it shows the value of the option and how it's going to be decreasing with time. For people that haven't seen charts of how options are kind of priced, you have the price and then you have the time. And as you get closer to the expiration date, the value of the option is going to go down because there are less days for the stock to move to get to the actual strike price. So this number means how much is the value of the option going to be going down with every given day, and it will always be negative. And so if you're buying an option, you're going to be Theta negative, meaning the longer the option goes on, you're going to be losing more money. But for people that are selling options like myself, we consider this strategy to be Theta positive, because as time goes on, the value of the option is going down, which means that we're going to be making more money. So this is a Theta positive strategy. And so here's the option chains for General Electric, which is currently trading at $11.50. And as you can see, the Theta is very low because, one, the option that we're looking at expires in 3 days. Two, it's a very cheap stock, meaning the premiums are very low. And then if you look at the $11.50 strike price, it's expected to decay by 2 cents each day until expiration, which is not that much. And then if you compare it to an expensive option like a Microsoft, you can see that the Theta is negative 0.25, meaning the value of the option will be going down by 25% every day until expiration. In my mind, Theta doesn't matter too much to me, but I think it's good to understand what the idea of Theta is and the difference between a Theta negative and a Theta positive strategy. The next Greek that actually matters to me is delta. Delta is a measure of the expected change in the value of the option based off of a $1 move in the underlying stock. This number will always be between 0 and -1 for a put and 0 and 1 for a call. But the way that most people kind of think of what delta means is the likelihood that the option is going to be in the money. And so for someone that is selling an option, for this strategy, the ideal situation is you sell a put and it expires worthless and you just keep your premium. And so the lower the number is for the delta, the better the chances that that option is going to expire worthless. So go back to the GE options. As you can see, as the price goes down for the put, the delta gets closer to 0 because it's less likely to actually be in the money. And so you can think of it as the expected move of the option based off of a $1 change in the underlying, but I think it's easier to kind of understand it as kind of the likelihood of the option being in the money. So the closer to -1 or 1, the better the chance that it's going to be in the money. And for this strategy, ideally, you're going to want to not be in the money. But we're going to talk about what happens if you are in the money. So depending on who you talk to, some people when they're selling puts want their delta to be -0.2 or -0.3. What this means that there's a 20 or 30% chance that your option is going to be in the money. For me personally, I like to have a delta of -0.4. What this means that there's a 40% chance of being in the money. That means that 40% of the time I'm going to be getting assigned the shares. The difference between people that are selling at a 0.2 or a 0.3 compared to what I do at a 0.4 is that I get higher premiums for taking on an increased risk of being assigned the shares. And so for me overall, I look for -0.4 when it comes to selling puts and 0.4 for when I'm selling calls. And the final important number I want to talk about is the IV, which stands for implied volatility. The higher the percentage for the IV, the more likely the market thinks that the underlying stock will have a significant move in any one direction. The higher the IV, the higher the premiums, mean that there's more money to be made for us, but it does increase our risk. It means that the likelihood of the underlying stock increasing or decreasing significantly goes up. And so it is good because we pocket higher premiums right now, but it does increase the likelihood of a significant move in the underlying stock. In general, IV increases around expected moves, stuff like an earnings report. Also when the stock market goes down. And a way that you can determine the IV of the overall stock market is by looking at something like the VIX. The VIX is a numerical way to determine how volatile the stock market's been. In general, when the stock market goes down, IV goes up. And there are some kind of scary situations where if you see the stock market's going up, but the VIX is also going up, that's kind of a red flag for a lot of people. But right now that number is much lower than it's been in the past year, which means that option prices are much lower than what we've gotten in the past. And I've seen that in my own trades, but we'll talk about that in a second. So now let's move on to part 2, where I actually explain the wheel strategy, because now that you understand the individual parts of it, you just need to put them together, and that's how you have the wheel strategy work in your favor. So the way that you open a wheel strategy is by selling a cash secured put on a stock that you wouldn't mind holding for the long term. The reason that I say that is if the stock decreases in value below the strike price, you're going to be the proud shareholder of 100 shares. But I do want to talk about the idea of rolling your options, because I watched a couple videos from other YouTubers talking about how they use a wheel strategy and how their goal is to not get assigned the shares, and that the way that they avoid doing that is by rolling the option. For this situation, if I'm selling a put and it's in the money and I don't want to get assigned, I can buy back that option and then sell one that's further away. The idea is that you are trying to decrease the likelihood that you're going to be assigned the shares, but in return, you are having longer exposure to that specific option. Also, you're probably going to be making less money because you have to go further away, and if the stock price has gone down, you're going to have to sell at a lower strike price. So overall, I don't really care about getting assigned. Some people are very adamant about rolling their options so they don't get assigned. I don't care too much. So as I mentioned, I find a put that has a delta of negative 0.4, which means that I have a higher chance of getting assigned than those people that are selling negative 0.2 or negative 0.3, but as I mentioned, that's not a big deal to me. And for those puts, I like to sell a put that is around 2 to 3 weeks until expiration date. That's just my personal preference. Some of the people that I've been seeing doing this will sell a put that's like 1 to 2 months away. That's not how I like to do it. I like to sell weeklies of around 2 to 3 weeks with a delta of negative 0.4. So here's my current Zynga wheel strategy where I sold a cash secured put for 42 cents for 2 weeks of exposure. Zynga just shot up after earnings. And so as a result, by the time this option expires on Friday, it's going to be worthless. So at this point, it's all theta decay. The value of the option still has some potential because there are still 3 days until expiration, but it's going to decrease as we get to the expiration date. So at this point, it's going to expire worthless. And what do I do with these premiums? It really depends on what you want to do. There's so many options that you can do with it. One of the things that you can do is you can just hold on to the cash, keep it in your portfolio. You can buy shares of the stock that you're selling the options for. That's my personal preference because since these are stocks that I would be comfortable holding for a long-term investment, I don't mind owning these specific shares. Another thing that I have done is I've been using the premiums that I bring in from the strategy to buy leaps. These are very long-term options, so I bought a very long-term call for GE that's going to be expiring in a full year. So I use that premium that I brought in from the wheel strategy to try to increase my returns in the long term, and you can do pretty much anything you want with that premium. So for 2 weeks, I was paid $42 for having $1,050 of collateral, meaning that I had a return of 4% for just over 2 weeks, which is a fantastic return. It is not the 100% returns that people have been seeing with like GameStop, but for a reliable way of making money, 4% for 2 weeks, that's incredible. I would take that all year. And you would have incredible returns over the course of the year if you could always get that. So one scenario that we talked about is where the stock stays above the strike price, like with my Zynga position, the option expires worthless, and then you kind of circle back, and if you don't get assigned, you just sell the option again. What happens if the strike price is above the current price of the stock? What happens is you're going to be getting assigned, assuming you don't roll that option. So let's talk about what happens if you do that. One of the current positions that I have right now is with General Electric. I sold a put, I got assigned, now I'm the proud shareholder of 100 shares. Could I have rolled that option? Sure, but I didn't care that much, so I was fine getting assigned 100 shares. So the next thing you do after you have these 100 shares, you're allowed to sell a covered call because you do have these shares to back that up. So this is part 2 of the strategy. So we sold the put, made the money from that, we got assigned. Now we're going to be selling a covered call based off of this position. And just like with my puts, I want to sell one with a delta of around 0.4. And usually I try to find one that's around a month out just because there's difference in the pricing between a put and a call. Calls, you have to go further out to get the same type of returns, and with a delta of 0.4, I found that 1 month to maybe 1.5 months is the perfect place for me to find those calls. And so I go to the options chain, I find one that's for 1 month away, and with a delta of 0.4, it has a premium of 36 cents. But it's also 50 cents above the current price that I got assigned at. And so this is where you get the benefit of having this strategy, because people always ask me, why don't you just buy shares of the stock because you expect it to go up in the long term? You get the benefit of what happens if the stock doesn't go up. So the benefit is I bought 100 shares of GE at $11.50, which is the current price, but I was paid 50 cents a share to sell that put, which lowers my cost basis down to $11. And now that I sold this call, my cost basis is going to be down to $10.65. And if this option gets taken away from me at $12 a share, which is a call that I would sell, selling at 12 with a basis of $10.64 is a return of almost 13% for around a month and a half of exposure. So that's fantastic returns, and it is much better than if I just bought at $11.50 a share and was selling at 12. So that's the benefit. If the stock remains relatively flat, you get to bring in these premiums, lower your cost basis, and have fantastic returns for a stock that's been relatively flat. So now I'll put this into a graphic. So first you sell the cash secured put, you bring in the premium. That's income source number 1. If it expires worthless, you do it again until you finally get assigned. Or if you're one of the people that don't want to get assigned the shares, you can continue to roll it, but it increases the risk because you are going to be selling this option for much longer. Then when you finally get assigned the shares, you sell a covered call to bring in more premium. That's income source number 2. If it's a stock that owns a dividend, you are able to bring that in. That could be income source number 3. And then if you're able to sell it above the level that you were assigned, that's going to bring in income source number 4. So I do see some people call it the triple income strategy. Could be 4 depending on how you're doing it. But once you finally get those shares taken from you, you've made some money and you can do it all over again. So it's just kind of this wheel that you keep going around in circles, and it brings in a reliable income, and you can do whatever you want with that. So now I want to talk about some of the important things that you need to know, because technically this is a strategy that leaves you very exposed to a 100% loss. If you're selling a put and the stock goes down to a penny, you're obligated to buy 100 shares of a 1 cent stock at whatever strike price you sold. Same thing with selling a covered call. Sure, you're bringing in some premium, but if the value goes down to zero, you're still holding 100 shares of the cost basis significantly above that. So it's important to remember that the companies that you're doing this with have to be companies that you fully believe in, because there is a potential that you're going to be holding them for the long term. And if you don't trust the company, probably not a great idea to be doing it with. Because worst case scenario, you own shares of a stock that likely won't be possible to be making 4% per trade, because the stock price has gone down significantly, that you run the risk of selling an option to make that 4%, but it's below the cost basis that you have, so you will be ending the trade with a loss, which is what we want to avoid. So as I mentioned, I don't like rolling my options. This is because it increases your responsibility length to more than 2 to 3 weeks that I want, and then around the 1 month that I do for a call. Also, I don't like having my cash being locked up for that long. Another thing to remember is that there's pros and cons with high option prices. For those of us that are selling options, it means higher premiums and higher returns if things go well. What this means is that the market expects the underlying stock to move significantly. We can see this with something like a GameStop. Currently, the IV percentage is at 260%, meaning that you're going to get some crazy returns. You can sell a put that will give you 11% returns for only 3 days of exposure, selling it at the money. But you have the increased risk because the market expects a stock to move up or down significantly. So that's just something to take into account, because you have additional risk even though you are bringing in that additional premium. So high premiums are good on one hand, but they also mean that you're exposing yourself to additional risk. Also, this is not a strategy that you're going to be using to hit a home run. The reason behind this is you are capping your gains by selling the covered call. This is something that's happened to me twice in the past year, where I've definitely limited my upside potential with something like a Sonos and a GameStop. These were stocks that I sold covered calls on. They increased in value significantly, and I had to sell at a much lower strike than what the actual price was. This is a strategy that could result in a lot of FOMO if you don't plan out your trades and you are susceptible to having emotional reactions to your overall trades. And so one of the ways that I like to do it is I write down my reasoning for why I'm opening these positions on a specific stock, because you can definitely have a lot of FOMO if you look back on trades with a crystal ball, knowing what you know now. But based off of the information that you had at the time, you decided to sell these options, limit your upside potential, but bring in the premium, and reminding yourself that, I think, is a very beneficial thing. And then finally, this is a strategy that has a lot of tax implications compared to these traditional just buy and hold, because if you buy and hold for more than a year, then you have the benefit of the long-term capital gains tax rate, which is much lower than the normal income. Since you are going to be selling options and bringing in income, that's going to be taxed at your normal income bracket. And so I think this is a strategy that you need to understand the tax implications of it, and it's the reason why I think it's beneficial to do it in a tax-protected retirement account, something like a Roth 401k or a Roth IRA, just because you don't have to worry about paying the taxes on the money that you're making from selling these options. So it's not critical, but it's something to know before taking the strategy. Now I want to wrap up this video talking about the pros and cons of the strategy. Pros, you're bringing in reliable income on stocks that you absolutely love and you wouldn't mind holding for a long-term position. 2, this is not a strategy that takes a lot of planning. Based off of the kind of the guidelines that I've set up, I know exactly what I'm looking for. 1 to 2 weeks of exposure for a put with a delta of -0.4. If I get assigned, then I'm looking for a call that's 1 month away that has a delta of +0.4. And that does not require a lot of time. I can just go in, sell the options, and go on with my day. So for someone that doesn't want to be spending a lot of time planning on specific option trades, I think this is a very beneficial thing. Number 3 is allows you to bring in additional income that you can do whatever you want with. You can buy options, you can buy shares, you can move it in other companies, you can do whatever you want. I think it gives a lot of flexibility and a reliable way to bring in some income. The cons, as I mentioned, the tax implications are important to understand. Number 2, you're not going to be hitting home runs. You are kind of capping your gains by selling a covered call. So if this is a stock that you realistically see doubling in price in the next couple months, I don't think this is a great strategy to be using. You could be selling the premiums and then buying a leap, which I have been doing on General Electric, but you're not going to be hitting a home run. And if you are susceptible to FOMO, you're probably going to have some FOMO by using this strategy because you're capping your gains. Overall, I think this is my favorite option strategy, and I think it's pretty easy for people to understand and start making reliable income from. So overall, I think this would be a great beginner option strategy. If you have any questions, be sure to leave them in the comment section down below, or a better way to get in touch with me is by joining my Discord, which will be the link in the description. So thanks for watching. I'm going to be making another video soon talking about the stocks that I like to use my option strategy for the wheel with, but I will see you in the next video. Thanks for watching.